You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm Andy Tanner, your host. This is where investing is made simple, and we're going to continue our series with the 4 pillars of investing, and I'm joined once again by Corey Halliday. How are you, Corey?
Hey, doing great, Andy.
So appreciative that you take the time to continue this little 4-part series. We've spoken about fundamental analysis, which is really analyzing the heart and the health of an entity, whether it be a household or a company, which is what most people think about fundamentals, and even nations. And I was in Vietnam not too long ago, and I got the chance to hear Mary Buffett speak, and of course that was a very fundamentally oriented speech. Looking at numbers and the health of companies, finding value. That's the way Buffett invests. It's the way the intelligent investor, Benjamin Graham, in that book invests. And then there were also speakers at this conference speaking about technical analysis, which is trends. And Corey, it seems like the longer the term you're going to have something, the more important fundamentals are. Of course, high-frequency traders and algorithmic traders that are doing things in nanoseconds are looking at more price movements and technical moves. I think they're both important. So before we move into the third pillar, cash flow, anything you want to say about fundamentals and technical analysis?
Those are kind of the first 2 pillars that you build upon, and I always think of it as fundamentals tell me what to buy, and technicals tell me when to buy. And when you really think about it from that standpoint, if you do your fundamental homework, you're going to be looking at companies and you're going to be valuing them. You're going to be looking at their valuation. What can I buy this company for versus its competitors? How does it trade compared to its history? And it really gives us a sense of whether there's real value there. Buffett calls it buying $1 but paying 50 cents for it. And that's really what we're trying to do is just find value. And today's lesson is going to really bleed into that, because when we talk about cash flow, we're talking about the lifeblood of corporations, of us as individuals. We have to have free cash flow in order to invest. And as corporations, we have to have free cash flow to be able to invest in our future, to go put more money into research and development and really to acquire growth. We have to have cash flow to be able to pay back our investors and pay out in dividends. And when that cash flow is tight, or when companies start to really struggle, that's a problem. And the charts, the kind of philosophy behind the charts is perfect, because it really shows you, people are doing their homework and you can see trends that last months, even years, bull markets and bear markets. And after the fact, this is why I like technicals, because a lot of things are hard to figure out in the moment, but the technicals will tell you the truth of it, right? It's hard to figure out that technology stocks could continue through the 90s and just keep going and going and going, but technicals would keep you on the right side of that trade. And then when the bubble burst, they'll get you on the right side of the downtrend as well. And so technicals are so important to be on the right side of the trade, because these trends that we talk about, bubbles boom and bubbles burst, but they'll last for years, and you want to be able to capitalize on both sides of those. So it really is a lot of fun when you put those pillars together.
There's what things should be worth, and then they're what they are worth. And fundamentals tell us a little bit about what they should be worth. Technicals tell us what they are worth. It's a lot like selling a house. The moment you decide to sell the house, well, what's it worth? Well, until that contract is signed and someone buys it, you don't know. And that's why the way you find out with what something's worth is sell it and see what people pay, and then you know.
That's right.
So one more thing on fundamentals and technicals before we hop into cash flow. So these are information gathering. I'm going to gather information about a company if I'm trading stock. I'm going to gather information about a real estate deal if I'm doing real estate. And then I'm going to gather information about the trend and the supply and demand. It's simply put, it's information gathering. And there's nothing I can do. I have no power over what the data says. I can't change a chart. I can't make Coke go up and go down. I can't affect their earnings fundamentally. So I would say if there's one word that we can put at the fore in this discussion is positioning. And, in our course, The Four Pillars of Investing, we talk about positioning from many different angles and views. For example, you can have a leveraged position with debt. You can have a debt position, or you can have a leveraged position with a contract. You can have a long position where you own something. You can have a short position, which is associated with getting paid for promises you've made. There's many, many different types of position. You have a position of cash flow. For example, rent puts you in a position of cash flow. Or if you're a house flipper, you're looking for a buy low, sell high capital gain. So, I think in our Four Pillars class, I think I have 7 different ways to look at how we position ourselves. So this is an important pillar. It's not as important as the fourth one, risk management, but they're all important, or we wouldn't have 4. If there were, if there were only 3, we'd have 3.
That's right.
But what you and I do, Corey, every Monday is Corey and I have a joint account that we actually trade together. So we intimately understand, the way each other thinks in terms of trading, because we do this weekly. And it basically, on Monday, the idea is for you and I to come with ideas if there's anything new we want to do. And that comes through fundamental and technical analysis. And then we say, okay, how do we want to position ourselves? And so the cash flow is simply taking that information fundamentally and that information technically, and you and I look at each other and say, oh, Corey, what do we want to do? What action do we want to take? Can't change fundamentals, can't change technicals, but we can change our position. So this is where we start to gain power. And let's start off with 2 basic positions, the long and the short position. These are capital gain positions, not cash flow necessarily positions. We'll get to that. In the Cash Flow Academy, you got to talk about cash flow. But I guess let's not, we have courses to teach what these are. What I'd like to speak about, Corey, is the freedom that it gives you in being able to open up the playbook, so to speak. I love, my Utah Utes and Kyle Whittingham says we're going to really open up the playbook. And the more you have in your playbook, well, you can get in trouble with having too much, but you certainly have a lot more tools in the toolbox if you have a run game and a pass game, as opposed to just the run game or the pass game. If you have both, it helps you. If you have a quarterback that can scramble and run, they call it a dual threat quarterback, where he's not just a runner, not just a passer, dual threat. As you expand the positions you know how to take, it gives you a bigger palette of opportunity to exploit. Would you speak about the freedom that a solid understanding of positions gives the investor and the trader?
Yeah, I really like how you described it as getting long or getting short and those types of strategies, because in essence, that's what we're doing. We're saying, do I want to buy something for a capital gain? When I go long an asset, I want its value to go up. That is, a buy low, sell high mentality. Now, we could buy real estate to do that. We can buy a stock to do that. We can buy an option to do that. The idea is we're paying X amount and we want to sell it later at a higher price. That's one form of strategy. The other form of strategy is kind of like real estate, where you can own an asset and you can generate income off of it. Mm-hmm. Or even in the options market, we don't even have to own the asset. We can just generate income, making a promise to buy the asset at a future date. And that's what we really like to do, is we like to look at these different angles that we can take and say which one makes the most sense for our account. And even though we trade maybe a larger account size than most, we still have, there's always a limitation on funds. Even Warren Buffett, he's investing billions of dollars. He still has a limitation on funds, right? He can't buy everything at all times that he wants. So as investors, we have to look at it and say, how much of our capital are we willing to put into this one position over time? How are we going to build that position? But most importantly, how are we going to stack things in our favor? How are we going to make it so that if we do buy this position, we buy it at a deep discount to current prices and we collected premium along the way? And so as we look at these different angles, we can really, and that's what I love about, the 4 pillars, is we can look at these and say, based on this chart pattern and the fundamentals, here's where we want to buy.
Yep.
And we can really define the stock is trading at 80, but we would feel comfortable. There's heavy support at 75. That's where we want to buy. So we can structure a trade right around that says we're going to collect premium. If it comes down to this support level, we're going to acquire the stock at this level. If it doesn't come down, we're still going to make our money either way because we got paid money right up front. And that money that we bring in, those premiums that we constantly bring in, are cash flow.
Yes.
And then with that cash flow, you get to decide what you want to do with that. The Warren Buffett strategy is, and he does this. He sells naked puts.
Yes,
he does these strategies that we're talking about, because that cash flow coming in, it's like insurance, which he loves. Berkshire Hathaway owns Geico.
Yeah, he owns Geico.
And think about why they love insurance. They collect premiums from all these households, and they get to reinvest that premium. Now, they do have to hold some money in reserves. They have to be able to make good on their promises.
Yeah.
And your brokerage will make sure that you have money in reserves. That's called a margin requirement. So it's done automatically. It'll tell you if you sell this option, well, it's going to require $2,000 of capital or whatever it is. That money is held in reserves to make sure you can make good on your promise. But then we collect this $200, $300, $400 premium, and we get to keep that money no matter what happens. That money can then be reinvested into a new stock. It could be, we could pay our bills. What we do is we just keep reinvesting it, right? We keep trying to compound. But I want people to really think about how amazing that is, that you can go out and click a button, make a promise, and get paid a premium. You can get cash flow that instant. It's just really amazing stuff.
Well, and even a bigger picture idea is most people's concept of their paradigm for cash flow is working for money. And I'll tell you, if you lay it out to a kid in the 8th grade like my son, and I say, okay, 2 ways you can go about earning money in your life. You can either work for money or you can have money work for you. Which would you choose? And 100% of the people, 100% of the time in every country I've ever been in, anytime I propose that question, they say, well, I'd rather have money work for me. Okay, so why don't we? Because we don't know how. Our paradigm in school it teaches us that cash flow is we toil and we get paid. We toil and we get paid. And investing is it's invest and get paid. But this is the secret sauce, is positioning, is understanding how to look at information, the fundamental picture, the technical picture, how to look at that information and then positions oneself through cash flow. Now, you mentioned a variety of examples, whether it's making a promise and getting paid, or buying something low and selling it high and getting paid, or borrowing it, selling it high, letting it drop, buying it back and returning it and getting paid. These are all different ways, making a contract and getting paid. So let me surmise this and make this clear, because it's so confusing for people with the work for money mindset. They're like, what are you guys even talking about, right? They would not understand the first part of this, because their paradigm is, look, I go to a job, I work for money, I save it up and hopefully have enough when I'm older. And that is just not the way investing works. So the first thing that we can do is we can position ourselves to profit from a move in price. Fundamentals and technicals give us insight where we forecast a move in the market, right? Up or down. The second opportunity we have is to exploit the movement of time. That's what I do with my rental properties. Is every month, those are paid monthly. And so rent is not paid based on fluctuations in the price of the home you're staying in. When I look at the rental homes I have, my renters are paying me money monthly regardless. My contract with them has no bearing on fluctuations of price. Think about that for a minute. It has no bearing on the fluctuations of price. We simply have an agreement to where they pay me rent. They have a certain amount of time, and that's a good feeling, because time, unlike prices, is much more predictable. I know that January turns into February, February turns into March. I know that. So I'm positioning myself to leverage a promise over time of service that I'm giving. I'm selling a contract. And it's nice. You mentioned Geico, no manufacturing costs, no packaging, no shipping, no raw materials. It's simply a promise you get paid for time to tick away. So insurance premiums are promises made that expire, and we profit over simply time moving by. We also have volatility opportunities in the stock market, that even a change in volatility, this is much different than the change in price. The changes in perceived danger provide an opportunity. So what cash flow is, and what this pillar is it's the opportunity Corey and I have each week or each day or each month, whatever your periodicity is, to look at information on fundamentals and technicals and then say, look, this is how we're going to position ourselves to make money. Comments, Corey?
Yeah, I mean, that's really the lifeblood of any, when I think back to the financial crisis, you go back to 2009, and a lot of people look back on that with regret, and they say, well, why didn't I invest? Why didn't I put more money into this or that? And a big part of it is cash flow, right? Yeah. Those that had cash flow, those that knew how to position, were able to take advantage of it. And those that weren't, they were just kind of caught like a deer in the headlights. They didn't know, how to act, how to take action. They probably knew, when you think back, you probably knew it was a good buying opportunity. You probably knew that there were assets out there that you could pick up for deep discounts, but not knowing how to position, basically that ship sailed by and you didn't take advantage. Now the question is, will there be opportunities like that again? Yes. Are there opportunities out there like that now? And the answer is yes. There are stocks that are trading at huge discounts to their historical averages that we can position for and be able to cash flow. We could buy stock right now and cash flow it just like a real estate property, where as time ticks by, we collect a premium on a month-to-month basis. And so when you know how to position, when you learn these different ways to position, you're able to profit from it. And some people might say, well, what if I think the market's going down? There's a positioning for profiting as the markets decline. And that's another avenue that I think is so critical about the financial markets, is where else can you profit as a company as the economy gets worse? How do you protect yourself? How do you hedge yourself?
Oh, paper's the best.
That's all positioning. Paper is the best way to do it.
Paper assets by far the best way to exploit those market moves. You mentioned positioning with cash flow. When you look at a real financial statement, you have the profit and loss, you have the balance sheet, and then you have the statements of cash flow. And there's really three parts to the statement of cash flow. The first has to do with the operations of the business, sales, money moving in, expenses, money moving out. And so cash flows through a business that way. But cash also flows through the balance sheet and the asset column. Cash is flowing into assets if you buy them. Cash is flowing out of assets if you sell them. And then you also have cash flow with debt. You have cash coming in when you borrow money and cash going out when you repay it. And so a statement of cash flow isolates those three ideas and shows you what your position is. So when Corey and I trade, right now it's an exciting time, Corey, because the 4 Pillars of Investing course has been our best course. People absolutely, the feedback we've had has been gratifying. So, you want to keep things current. You want to serve people well. So I've just been, as you know, re-recording the entire 4 Pillars series. So it's fresh, it's new, it's better than it's ever been. And you can't help but have the things you and I are doing now seep into that content of that course. Yeah. And so, for example, if you were to look at the positions that Corey and I hold, for example, we are short GameStop as a specific, right? We're short GameStop. Why? Well, that was a fundamental play, saying, look, their earnings are falling, their positioning in the market, of downloads. The guy that was in The Big Short disagrees with us. He thinks it's a buy, but we think this company could be fatally flawed. It's possible. We don't know that for sure, and we don't have a crystal ball. But we say, you know what? if this thing fails, we want to be in the position to profit. And if it exceeds, we want to be in the position to exit, which will be our risk management pillar next time. So we have short positions where we profit on things falling. We have long positions, like example, Coca-Cola. It had a gap down. It had some bad news. And we said, well, fundamentally, does this flaw the company? Certainly people want healthy drinks, maybe more than sugary ones, but Coke has inroads in health and water. They sell water just like they sell Coke and Sprite. And with the size of the brand, we said, is this fundamentally damaging to this company? Not in the long term. Let's buy it now when it's cheap and go long instead of short. And so it was really nice to get in on a nice dip and add more shares of Coca-Cola to our portfolio at a nice price that paid very well. We also have stocks that we're buying into in weakness. Kraft Heinz as it's fallen further and further. We've been excited to see that getting cheaper and cheaper because their dividend, they'll probably cut that dividend to come in line. A 6% dividend's a little high right now, but nonetheless, that's an opportunity to get closer to zero to buy into weakness. And we've done that both technically and fundamentally. And then finally, I don't think, do we have one position that we don't have an option on where we're not getting cash flow for time decay? Do we have any positions? I think every position we have. Talk about that for a minute.
Even GameStop, we've cash flowed at different times. And you look at GameStop, I mean, give Andy all the credit in the world because that's your baby. And that stock has lost more than half of its value just in the past couple of months.
Yeah.
So, you look at these opportunities out there and you think about it, and it all comes back to the four pillars. What is the problem with GameStop's company?
Fundamental.
Something that you taught me many years ago that I use every day in thinking about how I manage my own personal funds. Think about how cash flow works. You can work at a company and get paid to pay your bills. New money coming in, new money going out, right? I get paid a paycheck and I have to pay my bills. Or we can borrow money. But when you think about borrowing money to pay for things, there's a couple of reasons that companies might borrow. One might be strategic and they're in good financial condition. A corporation might say, I can borrow so inexpensively at 3% and I'm generating returns on investment of 10. Why am I not going to take advantage of what the capital markets are offering? So they can do that for strategy, but GameStop's not in that situation. Why is GameStop borrowing money? Why do they have debt? Because their cash flow is in reverse. They've been losing money, and so they have to figure out a way to keep building some funds up. Otherwise, they keep spending all of the money they have, and pretty soon it goes to zero. They can't allow their cash flow to go zero. They have to make their payments and so forth. And so as you look at these corporations and you think about why they're borrowing or how they're getting their cash flow or what their cash flow is in decline and why their earnings are taking a big hit, it's going to lead you to the best buying and shorting opportunities. Everybody thinks that Warren Buffett always buys things at a huge discount. When they bought Geico, it had doubled in value in less than 2 years' time. And then he bought the corporation. Think about that. He didn't buy it at the lows. He bought it after it had doubled in a relatively short period of time.
Right now, his largest position in his portfolio is Apple. And I think his cost basis is $200 a share, I believe. Don't quote me on that, but I'm almost sure that's true, that's his largest position now.
After it's gained billions of dollars in market cap, and now he sees that there's still opportunity there. And that's how the markets work. There's kind of this psychology that you have to flip your mindset a little bit. Most people, when they kind of look at investment opportunities, and I was like this when I very first started almost 20 years ago, I thought, well, this is going to be easy. Here's what I'm going to do. I'm going to go out and find the things that are down the most, because I thought it was like gravity. What goes down has to come back up. So I thought, well, I'll just find well-known corporations that are trading down massively, and I'll assume that they're going to recover at some point in time. that's not really how it works, because a lot of well-known corporations can falter and never recover. So you have to dig in and you have to do those fundamentals. I just thought it was going to be as easy as just go out there and buy something.
Word
No,
Perfect, Lotus, US Robotics, the list goes on.
Even some companies that are still around today have gone through a
bankruptcy.
Think about General Motors. General Motors went through a bankruptcy and now they're back in. So that wipes out shareholders potentially. So you have to be very careful about just the big name company that's trading lower. You have to look at it from the standpoint of sometimes they're trading at a discount, or sometimes they're
in trouble.
Actually fundamentally flawed. They've got big problems that become issues. And so the 4 pillars just take you through that process of really figuring it out. And it's not complex. It's just a lot of fun finding those opportunities. And if you find yourself enjoying the financial markets, if you like the idea of investing in value and finding opportunities and looking at your personal balance sheet and looking at ways that you can cash flow and do that, there is no greater teacher out there than Andy. I really believe that you are the best of the best.
Now we turned into an infomercial just like in 5 seconds right there.
Well, I'm telling you, you're the best.
we just turned into an infomercial. I will tell you this though, the reason this podcast exists and the reason the Cash Flow Academy exists for you is simply this: we are the place that was created for people that want cash flow other than a job. It's that simple. If a person wants to earn money other than a job, this is the place you go to learn the secret sauce. And this pillar is the secret sauce. It's the longest one we always have in the series. And so you have active income and you have passive income as 2 types of cash flow. Active income is stuff you work for. Passive income is money working for you. It's that simple. It's the first decision a person makes when it comes to cash flow is, how do I want to earn my money? Do I want to work for it, or do I want it to work for me? That's a fundamental decision. Yep. If a person says, I want to work for money, college is your baby, and the more college you get, the better. Doctors are going to make more than, let's say, sociologists, depending. Lawyers are going to make more than political science majors. So choose your education wisely. People, a friend of mine posted, is college worth it? Well, it was worth it for me because I had a great time. It's what you're trying to get out of it. For other people, it's not worth it all. You can't label college as good or bad. It depends on the individual and what they want. So if you want to work for money, then choose your career wisely, because you're going to spend a lot of time there. You're going to spend a lot of energy there. It's going to label who you are. Hi, what's your name and what do you do for a living? It's a big choice to decide how you're going to earn your money. If you've gone down that road and you don't like it, or you're starting out new and you think you'd rather have money work for you, well, that's what the Cash Flow Academy is for. That's what we do. And the idea is very simple. There's really 3 ideas to this. See what you think of this, Corey. The first one is the idea of building a passive income, to position yourself, to look at the fundamentals and technicals and create enough positions and assets that create a passive income above your expenses. That's the first goal. If a person has a passive income above the expenses, then that's rat race exit time. That's freedom time. Now, you're not rich. You're not rich at all, but you've got enough to where you can pay your bills and have your time. And that's an important thing, is to have time. We're always seeking more of that. One of the blessings, the biggest blessing I have isn't a big home or cars or, any of that stuff. It's time with my kids, man, to be able to be with them, coach their teams, be able to, if someone needs something, you say, hey, I can come. That would be the biggest thing, I think, is the freedom.
You always hear that the biggest regrets from people are not enough time spent with family, right? And so at the end of the day, that's what people want. That's what's going to make the most meaningful impact on their lives. And that's the goal. I mean, people ask me all the time, well, how do I get out of the rat race?
Yeah.
You've got to have a passive income that's greater than your expenses.
Look,
Period.
think about cash flow and how it relates to Maslow's hierarchy of needs. At the bottom of Maslow's hierarchy, you need air. Okay, we've still got that to some degree. As dirty as it may be, it's still keeping us alive. But you got food, clothing, shelter. So when you're born into this world, you have this problem of expenses of food, clothing, shelter, medicine. Okay, you go up to the next one. You want love and acceptance. Well, money doesn't buy love, but I'll tell you, investments of time in a marriage are very important. You don't put time in your marriage, you're going to struggle, right? And as you go up even into self-actualization, the fundamental problem that cash flow solves is the nagging, clinging, never-ending screaming of expenses every month. Every month we got to eat. Every month you got to have shelter. Every month you got to have medicine. Every month you got to have clothing. That nagging, when you can silence that little monster and put him to bed forever with passive income, that's the first step. That's why we create this podcast. That's why we create our academy. That's why we have our courses. Okay, the second part of this is, money just makes us more of what we are. And it just seems, Corey, that the moment a person is able to take care of themselves, then they seem to turn to want to look at others. And that's what you call legacy income. Now you're moving off just freedom, and you're saying, now, how do I position myself to where not only I benefit, how do my kids benefit? And if you can get you taking care of kind of this family dynasty going of education and wealth, then you ask the question, how can I help my community? And that's Buffett. That's Bill Gates. That's Kenny McElroy. That's guys, Than Merrill. That's the guys who start really, it's philanthropy. It gives you the power to be a financial philanthropist, not just with your time or your ideas, but also with significant capital, because, to cure cancer is going to take more than just nice, warm feelings and hopes. We got to put money into that thing and attack that problem with our dollars. When you look at racism, yeah, it's nice to say, oh, let's be nice to everybody. No, you got to attack problems like that with dollars, with the energy of cash. So cash flow is huge. It's what keeps businesses alive. What keeps things growing. It's what makes medicine. It's what makes health. Money isn't everything, but man, it's certainly something. And the cash flow in your life is worth working on. It's worth learning this pillar of positioning to say, how much debt should I not use? How much leverage of contract do I have? Am I leveraging OPE? How am I positioning myself to create value for the world where cash will come to me? So any final thoughts on this third pillar, this so important pillar of cash flow?
Well, I really think that this is the one area that touches everyone in some capacity, right? I mean, if you're going to get ahead, you've got to think about retirement. You've got to think about, what's my future? Do I like where I'm headed in this job? Do I like the amount of time I get to spend with my family? Would I like to be able to do more things outside of, currently what I can afford to do, and so on? It all comes back to money. And I like what you said, where it makes you more of what you are. That's really kind of what money can do.
Yep.
But the ability to kind of finance the lifestyle that you want is going to make for a happier marriage. It's going to make, so money can be good or bad, right?
Yes,
it's
it
just
can.
a tool.
It can and it is. Yep.
Yep. Yeah. It's just a tool. And if you think of it that way, I mean, nobody cares about the piece of paper. It's just about the opportunities that it offers you. And so if you look at it that way as a tool, you just start to say, well, how can I utilize it? How can I make the best use of this tool? And investing and cash flow is a way to basically give you more tools to operate with. And hopefully all of us have that goal of making a better life for ourselves, for our kids, for those that we come in contact with, and we can get into that philanthropy and we can make the world a better place. And it all comes back to, we've got to have a good enough knowledge of the financial markets and of cash flow to be able to get this working in our favor. It's the reason, the misunderstanding of that is the reason that most professional athletes end up broke.
Yep.
That most people that win the lottery end up broke.
They don't know how to buy things. They don't know how to buy stuff. They know how to spend. They know how to spend money, but they don't really know how to buy stuff. And there's a big difference. Huge
difference. And so you don't need that big windfall. What you need to do is figure out how to get these tools working in your favor to start generating positive cash flow. And even if it's just starting at a couple $100 extra a month, that's where I started. It was just baby steps. And then you work from there. That's really the goal for all of us, is to leave this world a little bit better than how we found it. And to do that, we need these tools working in our favor.
So the idea is to learn how to buy things. If we're going to have money work for us, you put your money someplace. And that's what the 4 pillars does is, we're caught in a culture of advice where people say, what should I buy? What should I buy? And it drove me nuts. I went over to Vietnam and I had a bunch of Q&A sessions. People were saying, should I buy this? Should I buy that? Should I buy gold? Should I buy Bitcoin? Should I buy property right now? Do you like stocks right now? And they're asking for advice. And please pause and please work as hard as you can to understand this difference. Is if you ask for advice, you're not getting smarter. In other words, getting the answer to a question doesn't always make you smarter. Let me say that again. Getting the answer to a question doesn't make you smarter. That's the problem with school. If you get good grades, people who get good grades think they're smart. Look, okay, watch this. Should I buy gold? Yes. Now, did you get smarter on gold? Should I sell my gold? Yeah. Yes. Did you get smarter on gold? But watch this. Gold is fungible. Okay, now we're starting to learn about gold, right? Now we're starting to learn. So when it comes to making that decision of saying, look, I don't want to work for money. I want to have money work for me. That means that I'm going to decide where to put my money. In other words, that's that position we've been talking about. I'm going to decide where to put my money. So how do I do that without having to take advice? Because Wall Street will give you plenty of advice, and the advice is always going to be this: give them your cash and they will take their fees.
That's right.
And you're not getting smarter. Is this a life skill?
They're asking the wrong question.
That's right.
It's not asking, what should I buy right now?
That's right.
It's asking, how did you decide what you bought recently?
That's correct.
That's a better question.
So the 4 pillars are designed to answer that question of what should I buy? How do I know how do I be one of those guys that has that Midas touch? How do I be one of those guys that seems to have confidence in knowing what to buy? How do the guys that are giving the advice figure out what to do, right? How do I want to be that guy? Well, that's the 4 pillars. Fundamentals, right? Technicals, cash flow, risk management. Those 4 things are the things that help us make those decisions. And of course, cash flow is so important because that's when you pull the trigger. That's where you decide, I'm going to be long, I'm going to be short, I'm going to go into debt, I'm not going to go into debt, I'm going to leverage this contract, I'm going to exploit time decay. This is how I'm going to do it, and this is how I'm going to make my investments run. Corey, great to be with you, man. Really fun to do the series. Next week will be, when we get to it, the next one is the most important pillar. I almost like to put it first, but chronologically it's almost be best last, because it's the last thing you do before you pull the trigger is work on figure out your risk management plan. And so it is the most important pillar. I will say this in setting it up and kind of giving a little teaser for it. Most people think that the reason someone like Corey's confident in making his investments because he can predict the future. He just has this calmness because he has this oracle. He's just this guy with a crystal ball. He's this guy with a crystal ball. Au contraire. The reality of it is that Corey and I make these decisions. We get on the Titanic not because we feel it's going to sail safely. We would only get on it. We wouldn't get on the Titanic. We would have never gotten the Titanic, not because we could have predicted the problem. It's just there were insufficient lifeboats.
The risk management.
The problem with the Titanic was not an inept captain. It wasn't a bad journey. It wasn't the iceberg. The problem wasn't even the ship sink. There was no problem with the ship sinking if they'd have had sufficient lifeboats. And so it was a risk management issue that killed him. That's what we'll be speaking about. I hope you've enjoyed the third part of this series on the 4 pillars of investing. We'll be back next time with Corey Halliday to talk about risk management. Corey, thanks for joining us. And this has been the Cash Flow Academy Show, where investing is made simple. We will see you next time.
You've been listening to the Cash Flow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.